Let's talk about a bit about finance management. I'll try to give an overview of the subject. I am not a subject expert. I don't have a background, but in management, finance management or financial management is an important part. So an MBA has to study that too. An MBA finance specializes in that. Other MBAs also have to study something of that sort. So all managers and all business people or CEOs need to be aware about, maybe not be thoroughly uh, specialized in it, but need to know the basics. So I'll talk about the basics very briefly. We are assuming that we are talking about a company which is not in the finance business. It's not a financial services or a finance company. It's a normal company, and finance here plays a support function, a staff function. Let's say the company is a manufacturing company. It produces and sells things. So how does finance or financial management play a role? And we talk of finance and accounts when we talk of financial management or finance management. Firstly, if we talk about accounts, it's basically recording. Accounts, businesses have transactions. You buy things, you sell things, there are costs. So everything is recorded. And then financial statements are prepared through a process, and which are known as your balance sheet and profit and loss account. Some of these are statutory mandatory requirements because you have to submit these statements for taxation purposes and for reporting purposes, depending upon the kind of company that you have. Listed companies, limited companies have bigger compliances and reporting requirements. So accounting is basically about that. And now you have software. Basically, earlier we used to do, maybe there was single entry accounting, then we have double entry accounting, and then we have software to do. So just input the voucher values and plus costs and what you have spent and what you have received, and everything is entered, and the software prepares the accounts. All the accounting statements are prepared by the software. Even the analysis is done by the software. So the accountant's role is in a way assisted by the software, various kinds of financial softwares. And that was in softwares also, the first softwares that came were financial management softwares. Even a simple software like Tally, to maybe complicated systems like SAP, ERP systems, which have modules on finance. So accounting is the recording part of transactions. Then you have the analysis of financial statements, like you have a balance sheet and profit and loss accounts. An analysis is usually done by something called ratio analysis. There are various ratios which tell you about the performance of the company, the profitability part of it, the liquidity part of it, the solvency part of it, the efficiency, the turnover part of it, how efficiently it is turning over various things, how efficiently it is controlling various things. So there are a set of ratios which help you in analyzing. You can do a trend analysis where you compare your ratios, past ratios to current ratios, or you can also compare ratios between companies or among companies if the data is available. So ratio analysis tells you about the performance of the company, financial performance of the company, business performance of the company, efficiency in various things, turning over inventory and all that, control and all that. So ratio analysis is a very important part of financial statement analysis and financial appraisal or financial analysis. You also have a lot of legal compliance requirements related to financial matters and business aspects. So bigger companies, listed companies, public limited companies have a bigger role as far as compliance is concerned. A lot of statements and data has to be submitted to government authorities and all that. So there are people like company secretaries and legal departments and who study company law, who are experts in company law. So the whole part of company law aspect, the legal secretarial aspect here means company secretary aspect, and reporting aspect, the compliance aspect of the company law and regulatory aspects. If you have taken money from the stock market, then SEBI, you have to submit data to that. So public limited companies have their financial statements are available to the a private small businessman doesn't have to share his information except maybe for income tax. I mean, if I am just a small proprietor, you don't need to get to see my balance sheet. But if I am a public limited company, my balance sheet has to be made available in the public domain. So the compliance and transparency and those requirements go up. You also have the the other part apart from finance is one major part. The reporting part is one part. The other part is costing. You need to, there is a whole thing about costing, cost management, cost analysis, cost accounting, so that you know what your cost structure is and how do you allocate your cost to arrive at good pricing for your products. What part of cost is apportioned to that particular product, because you have to recover your costs and make profits, and you have to also look at competing prices. So a study of costing and cost accounting helps you in pricing decisions and understanding whether you're making money or losing money, and where do your costs are high or low, and where you need to control and manage those costs. So cost center accounting, costing, there can be cost center accounting. Sometimes you need to analyze whether a particular product line is making money, whether some particular business is making money. So you do a cost center, a profit center accounting to find out whether one particular part of your business is profitable or not. The company can be making so many products and running so many businesses as a corporate group. Which section is profitable, which section is not profitable? There, if you have proper cost center accounting, profit center accounting, you can find out if that particular line of business or product is profitable or not. So that is an important element of finance and accounts. You need to study taxation, of course, because of that is also involved in financial aspects and financial management. So studying taxation, changing trends, changing government rules and regulations, those kinds of things are also there. When it comes to finance, we are talking more about raising money, capital structure of the company. What should be the capital structure? What should be debt? What should be loans? Should there be any equity? How much should the owners put in? Should we take money from the stock market? Should we take money from venture capital? How do we need so much money totally. So how do we collect that, raise that money? And how do we reduce our cost of capital? Money has a cost. If you take money from the bank, you have to pay interest. So reducing your cost of capital, you have to pay dividend to your shareholders, and if you take equity, then also you have to share profits and all that from private equity or venture or your partners. So reducing cost of capital, deciding upon the capital structure, raising that money is the finance part. Where to raise money, how to raise money, how to raise money as cheaply as possible, as quickly as possible, and then allocating the money for the business requirements and seeing to it that it is not misused or misallocated. Long-term finance should be used for long-term projects, not for short-term projects. Short-term loans should not be used for long-term money. So all this controlling, raising and allocating financial resources is a major part of finance, financial management. Sometimes the treasury function is about when there is excess money, surplus money, then what do you do? Business has there are reserves, and there is your business has, you have got money, your business, after all your expenditure and dividend and all that, retained earnings and reserves, where do you park that money? Where do you put that extra money? Where do you save that money? Where do you invest that money? That is not your business activity, but business is generating extra money. So what do you do with that extra money? So that is something like treasury management, which would also be part of financial management, which is a treasury function. The other thing would be working capital management, day-to-day control. You would also need to have budgeting, where you have to plan. I'm going to need so much money, and to run my business. So where would I be getting the money? How would I will need money to pay salaries and pay my bill suppliers, and I'll be collecting money from my customers. So handling that, controlling that whole aspect is also an important part. Inventory control, the money is not stuck in inventory. you are able to collect money from the market, from the outstanding is control is there, and that is working capital management part, budgeting part, working capital management part, cost control or management control part. That is MCS, management control systems. One of it is financial control. Auditing is also one of the important things that you do. Internal audit and external audit. External audit is sometimes compulsory in many cases. Internal audit is when you actually do auditing on your own. You check against the benchmarks of what is happening, what is actually happening, what was approved and what was done, what is the standard and what has been done. So there is an internal audit team which also looks at these aspects. Then there are decisions about new projects, new businesses. Should you enter into a new business? How do you decide whether you enter in this business or that business? Then you have to look at the basic concept of time value of money is one of the important considerations. Money today is more valuable than money tomorrow. 100 rupees today is better than 100 rupees 10 years later because of inflation and interest and those phenomena. So that's called time value of money. Money in hand is more valuable than money down the line or later on. And based on that, you have various calculations like net present value, internal rate of return, and all that to analyze whether to invest money in this project or that project, or whether this particular project makes sense. Is it profitable? Should I be putting money in this project or not? You look at things like break-even point. When do you start breaking even? You look at payback period of a particular project. So these decisions are also important in financial management. Then there are valuation aspects where if you are going to buy a company or sell a company or buy some part of it or sell a stake in the company or getting into joint venture, then valuing your business, the whole aspect, that share market part of it is also involved, and the other actual assets and stocks and all that is also involved. So there are various methods of valuation, and when buying or selling a company or a part of a company, so valuation is also an important part of finance and accounts management. So I have tried to give you an overall idea about what finance and accounts or financial management or finance management involves, which generally you should know. Thank you.